The rich don't invest like the rest of us, because they play by a different rulebook. While most people chase quick wins, the wealthy focus on cash flow, leverage, and long-term power moves that quietly multiply their fortune. In this video, I'm breaking down the 7 investing rules the wealthy actually live by. Rules that build generational wealth, not just temporary gains. If you want to invest smarter and grow like the top 1%, watch this till the end. 7 investing rules the wealthy live by. Wealth isn't built by chance. It's built by design. While the average person looks for quick wins, the wealthy follow a very different set of rules when it comes to investing, rules that protect and multiply their capital for decades. Let's break down the 7 powerful investing rules that the world's richest individuals quietly live by. Rule 1. Never lose money. Rule number 1 by Warren Buffett sounds obvious, but it's one of the most ignored principles in investing. Warren Buffett famously said, "Rule number 1, never lose money." Rule number 2. Never forget rule number 1. Wealthy investors understand that avoiding big losses is more important than chasing massive gains. They're obsessed with capital preservation. They ask, what's the downside? How do I protect my principal? Is the risk worth the reward? Before every investment, they plan for worst-case scenarios. Because when you lose 50% of your money, you need a 100% return just to break even. The rich focus on asymmetric bets, where upside potential far outweighs the risk. Rule 2. Cash flow, capital gains. The average investor chases price appreciation, hoping to buy low and sell high. But the wealthy? They prioritize assets that produce consistent cash flow. Why? Because cash flow is predictable, scalable, and reinvestable. It allows them to compound returns without selling the asset. Think dividend-paying stocks, rental properties, private equity, royalties, and intellectual property. They buy assets that pay them monthly, not just someday. Cash flow builds financial freedom. It reduces reliance on market timing and creates liquidity for future opportunities. The rich treat investing like buying businesses, not just flipping assets. Rule 3. Leverage debt. Don't fear it. Poor people fear debt. The wealthy use it as a tool. But here's the key difference. The rich borrow to buy assets, not liabilities. While most people get into debt for cars, phones, or vacations, the rich take strategic debt to buy real estate, invest in companies, or grow their business. Good debt comes with low interest rates, tax advantages, leverage on appreciating assets. Wealthy investors understand how to use other people's money, OPM, to multiply their own wealth, while minimizing their personal financial exposure. Rule 4. Taxes aren't just a cost, they're a strategy. The poor pay taxes like a bill. The rich treat taxes like a game. They invest through trusts, corporations, real estate structures, tax advantage accounts. They don't evade taxes, they optimize them. For example, real estate investors use depreciation to offset income. Business owners deduct expenses. Investors structure their capital gains to defer taxes. By reducing their tax burden, they preserve more capital and reinvest it. This is why some billionaires legally pay less tax than middle-class workers. They're not smarter, they just play by a different set of rules. Rule 5. Diversify, but not too much. Average investors over-diversify because they fear loss. The wealthy diversify strategically. They spread risk across asset classes, stocks, real estate, business, commodities, geographies, domestic versus international, time, short-term liquidity versus long-term growth. But here's the secret. The rich often go deep on what they understand best. They focus their money in industries where they have expertise, influence, or access. They don't invest in 100 things. They invest in 10 high-conviction plays they understand inside and out. Diversification protects you, but concentration builds wealth. The wealthy balance both. Rule 6. Buy time, not just things. Wealthy investors don't just use money to buy things. They use it to buy time and freedom. This shifts how they invest. They prioritize passive income streams over active labor. They automate and delegate. They build systems that run without them. This is why they love businesses, real estate, and private equity, assets that grow while they sleep. They aren't chasing status. They're chasing leverage, ways to earn more by doing less. If your investments don't give you freedom, you're not really rich, you just have money. Rule 7. Play the long game. The wealthy don't think in weeks or months. They think in decades. They understand that the most powerful force in wealth building is compound interest, and compounding takes time. They avoid emotional decisions. They don't panic during market crashes. They don't jump from trend to trend. Instead, they reinvest their profits, let their winners run, stay consistent through all market cycles. Compounding turns $1,000 into $1 million. If you're patient enough. That's the mindset. Long-term, disciplined, and unstoppable. The wealthy don't rely on luck. They follow a financial code, one that prioritizes patience, principles, and perspective. They don't work harder. They think smarter. They protect what they earn. And they invest like their life depends on it, because it does. If you want to build wealth like the rich, don't just study what they buy, study how they think. These 7 rules aren't secrets. They're available to anyone. The difference is, who's willing to follow them? Now that you know how the wealthy invest, the real question is, are you ready to think like them? Drop a comment below with the rule that stood out to you the most. Don't forget to like this video, subscribe, and hit the bell so you never miss the strategies the rich don't want you to know. Up next, we're diving into the cash flow system the rich use to retire early, and trust me, you don't want to miss that one.